So today's discussion is going to give you important insights on answering that question, is my business ready for funding? And we have an amazing speaker to guide us through this conversation today. I'm excited to introduce Oren Shani. Oren is a credit advisor and program manager and certified business coach with AOF. Oren has over 10 years of experience managing businesses and advising other business owners. He started, managed, and expanded his own business, providing disability accommodations for live events across the country, and he now helps entrepreneurs launch and grow their own businesses. Hey, Oren. Oh,
Thanks, everyone. Good to be here.
wonderful. Okay, so we're going to go ahead and jump into it because we have a lot of really great information to share today. So I'm going to go ahead and share my screen, Oren. But the first question I want to ask you is, what are the key components of a balance sheet, cash flow, profit and loss, and how do they reflect the financial health of businesses?
Yeah, absolutely. Happy to answer this, and thank you everyone for joining. I think this is really important. I'm a very kind of a more financially focused advisor, and I can assure you that this is one of the most important things that any entrepreneur or business owner should have in their entrepreneurial toolkit is this fundamental knowledge of financials, how to track the health of your business by looking at your financial statements. So just to kind of kick things off here, you've probably all heard of these terms before: a profit and loss statement, a balance sheet, and a cash flow. These are kind of the big three, right? The holy trifecta of financial statements. There are other supplementary financial statements, but these are really the big ones. You're all probably very familiar with a profit and loss. Most of my clients that I serve, they're very familiar with their profit and loss statements, but not so much their cash flow and balance sheets. So profit and loss, as most of you already probably know, it's basically tracking your profit, right? It's tracking all of your revenues, and then all that revenue is chipped away from all your expenses, your direct costs, production costs, overhead, rent, utilities, things like that. And then at the very, very bottom of that page of your profit and loss is what's left over after all of your expenses have chipped away at that revenue. Whatever's left over is your profit, right? That's the wealth that you have generated for your business. Congratulations. It could either be a net profit or it could be a net loss. Maybe your expenses are higher than your revenues. Therefore, you would be ending that period with a net loss. So obviously what you want is you want more revenues than expenses because you want to have that residual amount of money left over, which is what we call your net profit, right? Or your bottom line, as they say, I guess Wall Street lingo. So that's a profit and loss. It just tracks your revenue, your expenses against your revenue. Pretty simple. And then we have, I'm gonna skip over to cash flow because it's a good segue. So your cash flow, it's kind of similar in the sense that you're tracking cash coming into the bank accounts and then you're tracking cash leaving the bank account. So obviously, if you have revenues from your profit and loss, that's going to convert into cash. That cash is going to come into your bank account. So that's a cash inflow, right? You pay your bills, you pay your expenses. That is outlined on your profit and loss: rent, utilities, overhead, direct costs, labor, all that stuff. So that's going to be cash leaving your bank accounts, right? So that's going to be a cash outflow. So that's essentially what a cash flow statement is. It's monitoring all that movement of cash in and out of your bank accounts. And also, it tells you at any given point in time how much cash you have in the bank account. So I say this a lot. I love this analogy, but your cash flow is essentially the respiratory system of your business, right? We constantly have to breathe in and out to be healthy, right? Same thing with your business. Your business has to inhale cash and exhale cash to operate efficiently, right? And obviously you want more cash coming in than cash leaving. But basically what the cash flow is telling you is how much cash you have at any given moment. So if you're looking at potentially investing in equipment and machinery, you want to take a look at your cash flow. Do you have enough cash for it? If you are operating in a net loss, let's say you just opened your business and your expenses are high, your revenues are low, which is very normal. So maybe the first 3, 4 months you're operating at a net loss. Well, you also want to look at your cash flow to make sure that you have enough cash in the bank to cover those net losses, right? You can run your business on a net loss on your profit and loss. You can't run a business with net negative cash, right? That's the big difference here is profit and loss is a little bit more forgiving in the sense that you may be able to still operate your business if you're operating on a net loss, but with a cash flow, you always need cash. If you have negative cash, you're not running your business. So that's kind of the big thing with cash flow. Again, it's kind of like that. You always want to make sure that that relationship between cash inflows and outflows is healthy. You're maintaining a certain level of cash in your bank accounts. You never want to be at a zero balance. So that's why cash flow is very important. And then your balance sheet, maybe probably the least important out of these three for the purposes of a small business, especially just getting up and running. But a balance sheet is basically a snapshot at any given moment in time, a snapshot of the value of your business. So you're probably familiar with that famous equation, right? Your assets equals your liabilities plus your equity, right? And that has to balance, right? Your assets need to be the same amount as the summation of your liabilities and your equity, right? The reason for that is it tells you, okay, well, so here are all my assets, right? This is what's creating value for my company. This could be cash. Cash has value. It could be your inventory. Your inventory has value. It could be company vehicles that has value. So these are all the things when you aggregate or add them all up, this kind of gives you an indication of the total value of the assets of your business. But then you go to the other side of the equation to liabilities and equity. Your liabilities are going to be are essentially money that you owe, right? So loans, accounts payable, notes, monthly debt payments, short-term debts, long-term debts. This is money that you owe, right? That's going to be chipped away at your assets. Okay. So assets is what the company owns. Their liabilities is essentially money that the company owes to somebody else. And so what's left over essentially is what we call net equity. Kind of a similar format as a P&L. You have revenue minus expenses equals profit. Balance sheet kind of operates in the same format where you have assets minus your liabilities equals your net equity, meaning the net value of your company. And that's something that investors, if you're interested in looking into investors, they're going to look at your net equity. They want to see after all, money is owed, after all that money is kind of paid back through all your loans and all your payables, whatever's left over is the true net value of your company. That is the wealth that has been secured by your company. Right. So that's kind of what we look at for a balance sheet, but that's not necessarily going to be like what you need to be tracking on a daily basis. That's more of like, okay, well, let me just, take a moment to see where my business is at in terms of the valuation. If I were to put a number on the monetary value of my business, I'll take a look at the balance sheet, but that's not really going to tell you how your day-to-day, business performance is necessarily. That's going to be your profit, loss, and your cash flow.
Got it. Okay. Wow. I know just hearing about all of these, there's so much good information and such great points. And I know we're going to dive deeper into assessing your business's financial health because that's a huge part of accessing funding. But whether it's reviewing your balance sheet or checking your cash flow, it's clear that having that solid foundation in financial management and understanding is really critical for your business. So if
Mm.
you're out there and you're feeling overwhelmed, I'm so excited to share one of our new resources for businesses. It is the Learn with AOF platform. And it's free, it's flexible, it's specifically designed for business owners to help you grow and thrive with some of that financial information and those learning pathways and tools. It literally only takes 2 minutes to get signed up. So we're going to drop this latest resource in the chat, and we'll be talking about it throughout our conversation today because it is so relevant. So I just wanted to mention that. And then I want to continue on our conversation. So we've talked about all of these documents, but how do we truly assess whether our business is financially healthy enough to seek funding?
Yeah, that's a really good question. So if we're looking into for going kind of down that rabbit hole of I need capital for my business. I need to fund my business. Obviously, anybody that you're talking to, whether it's a lender or an investor, or even maybe a personal friend that just, is interested in helping you out financially, they're going to be looking at the same things that you're looking at to determine the health of your business. So obviously, it starts with those financials. Assessing your profit and loss, making sure you're generating healthy profits, looking at your cash flow to make sure that you're maintaining that a reliable amount of cash in the bank accounts, and you're not depleting the bank accounts, right? And then even the balance sheet, just kind of assessing the monetary value of your business as a whole. Those are kind of that's step one, right? Step two is kind of asking yourself the question, why? Why are you seeking funding? What's the purpose of this? How is this going to help my business? What's the opportunity here? There's a saying or a funny phrase in the lending world that goes, the best time to borrow money is when you don't need it. And it's very true. You don't want to be in a state of desperation as much as you can help it when you're seeking funding. You don't want to seek funding just to survive. That's not necessarily the best approach with it, because ultimately, if it's a loan, you're going to have to pay it back, right? And just surviving, just breaking even, isn't giving you the necessary additional cash flow to be able to pay back that loan. So seeking funding in a state of financial desperation is I won't say don't do it. I'll just say be very careful with that, because you don't want to be in a position where you're just not able to pay back the loan. Whereas, if your business is performing relatively well, you're generating profits, your cash flow is good, and down the road, you plan on maybe in 3, 4 months from now, you plan on opening up a new facility, or taking producing more inventory that's going to come with more upfront costs. Maybe that's an opportunity to think about, maybe I should subsidize my cash flow a little bit for this expansionary kind of growth phase that I'm in, which is a healthy approach, because you have good cash flow already. So you have the capacity to be able to pay back that loan. And the purpose for getting that loan is to expand and grow your business. So you really just have to ask the question, why am I doing this? And does it make sense? And am I going to get a return on this investment of taking out a loan, right? Because that's essentially what it is. You're taking out a loan, you're going to pay for it in interest. It's a cost, it's a business cost. So you want to make sure that you're deploying that cash in such a way that you're going to get more back than what you're spending to borrow that capital. So, if for every dollar you're paying interest, you want to get at least $2 back in increased revenues from whatever it is that you're investing that loan money into, if that makes sense. So to answer that question kind of in a short answer, understand why you're taking out a loan, put together a strategic financial plan for it, and know how you're going to allocate that cash, know to a certain degree of confidence how that investment is going to come back to you and increase revenues.
Yeah, I like that. Not only what, but how am I going to use it, and how down the road is it going to grow my business? Because that just kind of really expands your mindset and shows you like what that money can really do for you. Okay, so the next question is, what financial statements should I have ready when I am approaching investors or lenders?
Yeah, exactly. So kind of similar, like I said before, anybody that is looking to give your business cash, whether that's through a loan product or through equity partnerships or investors, they're essentially looking at the same thing that you should be looking at to monitor the health of your business. So, as far as what financial statements you will want to prepare for them, basically it's going to be, your profit and loss, your balance sheet, your cash flow. Now, if we're talking about lending specifically, because investors and lenders kind of look at different things. So if we're focusing on like a loan, for instance, they're going to want to see a few things. So number one, they're going to want your tax returns, personal and business tax returns. Now, the reason they want personal is 99.999% of the time your small business is going to take out a loan. You're going to be required as the owner to guarantee that loan, meaning tie your personal financial information to that loan. Why? Because you're a small business. You're not a major, multi-billion-dollar corporation like McDonald's that's been around for hundreds of years, that has established its business credit. Most small businesses don't have enough established business credit to take out a loan without a guarantor. So 99.9% of the time, if your small business is taking out a loan, it's also they're going to do what's called pierce the veil, go past your business, even if it's an LLC or a corp and has legal liability, they're going to pierce that veil and they're going to go straight to your personal financial information, right? That's kind of how lenders protect themselves. So that's why they're asking for things like personal tax returns. But the tax returns are going to tell them essentially your profit and loss. If you're familiar with your business tax returns, there's a section on there that goes over all of your revenues, all of your expenses, and then your leftover profits. So they're going to want to look at that because that's been verified with the IRS. It's accurate. They can take that with a certain degree of confidence that that is accurate information, right? And then the cash flow. So they're not necessarily going to be looking at a cash flow statement. What they're going to do is they're going to ask for 3 to 6 months of consecutive bank statements. And this is how they do their cash flow analysis. They want to see in 3 to 6 months of consecutive bank statements, they want to see that you have maintained a healthy amount of cash in the bank. Like they don't want to see zero balances in your bank accounts. They don't want to see that you've overdrawn your bank accounts. They want to see a healthy cushion of cash in your bank accounts throughout this period of time that they're asking for, 3 to 6 months. They're going to look at all the deposits coming into your account. They want to see that you have a consistent, frequent cadence of money, cash coming into the bank accounts, and they want to see how much cash is leaving the bank account. Exactly what a cash flow statement tells you. Your bank statements are essentially a cash flow statement, right? It's telling you how much cash is coming into the account, how much is staying in the account, and how much is leaving the account. So that's what we mean when they do a cash flow analysis, is they're just looking at your bank statements. Balance sheet, not so much. An investor might be more interested in a balance sheet. Lenders are not necessarily as interested in the balance sheet. They don't really care what the value of your business is. They just want to make sure that you have enough money to pay back that loan, right? Those are the financials that they're looking at. As far as a personal financial statement, again, you're guaranteeing the loan. So they want to see you personally. What assets do you personally own outside of your business? What debt obligations do you have outside of your business? Maybe you have a car, you're making car payments, maybe you have a mortgage. They want to see that too, because they aggregate all of that together, your personal and your business, and they assess what your loan capabilities are based on your personal and business financial situation.
Oh my goodness, so many good things in here. And I see a lot of questions coming in the chat, and we do have a Q&A at the end. So please continue to see those questions, and some of them might be addressed during our conversation now. Okay, so what financial metrics and ratios do investors and lenders prioritize when evaluating a small business?
Yeah, that's a good question. So again, there's going to be some variation between investors and lenders. With investors, they're looking at your profits and they're looking at your revenues, right? And they're probably taking a look at your liabilities. They want to make sure that you're not overly leveraged in debt. But generally speaking, the investors are looking for revenues and they're looking at profits. Lenders, on the other hand, they're looking at your credit situation. They're looking at how much debt you already have, and they compare that against, the amount of money that you're bringing into your business. So that's where we get into this very common metric that I think everybody needs to be familiar with if you're looking for loans. It's called the debt service coverage ratio. Which measures a firm's available cash flow to pay its current debt obligations. Basically, this is a little bit fancy terminology. It's essentially basically measuring how much profit you're generating, how much of that surplus cash you've generated after you've paid all of your expenses, and then um, comparing that against all of your minimum monthly debt payment requirements, right? And then essentially this equation is asking how many times are you able, through your profits, how many times are you able to pay your minimum monthly debt payments with those net profits? So the calculation here, we'll go over an example, but the calculation here is total debt service divided by net operating income. So let's say that your monthly debt obligations, meaning out of all the debts that you have in 1 month, and what are all those payments, those minimum payments? Because remember, you know that you have, if you have a term loan, you have a fixed monthly payment. If you have credit cards, you have a minimum payment that you have to pay every month. So if we aggregate or add all of those minimum monthly payments in 1 month together, that's your total debt service for that month. So let's say in this example, you have to pay at minimum $5,000 in monthly debt payments, credit cards, term loans, whatever the case may be. But then you look at your net profit for that month, your net profit's $10,000. So that means that you can pay your minimum monthly debt payments in 1 month twice. You can pay it twice, right? Obviously, you're not going to pay it twice. You're going to pay it once. But this is just telling the lender how what your capability is in terms of paying your monthly debts. So in this case, your DSCR is 2, because you can pay with your net profit. You can pay those monthly debt obligations twice. That's very, very healthy. That's a woohoo, yay, good job. Now, whereas if it's the other way around, let's say that your minimum monthly debt payments are $10,000 and you had $5,000 in net profit, then your DSCR would be 0.5, meaning you can only pay half of your monthly debt obligations. That's not a woohoo. That's a boohoo. So that's kind of what we're talking about with the DSCR. This is what all lenders will do. This is every underwriter will do this calculation, and it essentially allows them to determine how capable you are to not only pay your existing debt obligations, but pay the additional debt that you're taking on by talking to this lender and trying to take out a loan. Generally speaking, you want to shoot for about a 1.2 to a 1.5 DSCR score, because a 1.2 essentially is saying you can pay all of your monthly debt obligations once with a little bit left over, which is probably what is needed to take on an additional loan. So you want to shoot for about 1.2 to 1.5. That's essentially what lenders are looking for.
That's amazing. That's such a helpful ratio and metric to use, and I had no idea it existed. So I think that's really, really helpful, especially when you're just trying to assess if you're ready for that. So let's see, how do business owners create, or how can business owners create realistic financial projections that will appeal to investors?
Yeah, so I do a lot of work on financial projections with my clients. And essentially what we're talking about when we say financial projections, it's a forecast, right? You're essentially predicting the future with as much confidence as you can have in terms of how you think the business will perform, in the near future. So typically, if you're a new business, you're putting a business plan together. You probably want to have a financial projections for 2 to 3 years, and of course, it's going to change. It's not static. It's not 100% accurate. Again, you're predicting the future here. But the purpose of financial projections essentially is to plan ahead, be able to make certain assumptions about how your business is going to perform, and take proactive approaches now to be able to optimize, how your business is performing, based on those projections. Now, of course, those projections should not be arbitrary. They're not just numbers that you're throwing out on paper. You're not creating millions and millions of dollars in revenue just to make it sound nice. You need to be realistic, and it needs to be based. Those numbers needs to be based on a couple things, 3 things. Number one, if you're an established business, your projections need to be based on your historical actual financials. So if you've been 1 year, if you've been in business for 1 year, and you know how much revenue you've generated, you know how much expenses you've paid, you can use that as a baseline to develop your projections, determine what your growth is going to be based on those historical financials. That's number one. Number two is doing some market research, looking at your industry, looking at what we call financial benchmarks. So every industry has data in terms of averages. The average business in that industry. Let me rephrase. Your benchmarks is a indication of how well the average business in that industry performs. So what they do is they take financial data from some of the biggest companies within that industry. They look at their financials and they develop averages, and those averages set the benchmarks, right? So we're talking things like your gross profit margins, your net profits, labor costs, things like that. So what we do with the benchmarks is you look at those and you compare your financials against those benchmarks, right? What you want to do is you want to be able to perform at where those benchmarks are. So if the benchmark gross profit margin for your business is 60%, you want to make sure that your gross profit margins are at least performing at 60% or better, right? You don't want to be performing under those benchmarks. So that's also an indication of how you can put together financial projections that are going to be healthy and growth based, is if you're achieving those benchmarks, right? The third aspect of creating confident financial projections is key assumptions, right? Every projection has to have key assumptions. For example, seasonality. Let's say you're an ice cream business and you know that you can assume that your revenues are going to peak during the summer and they're going to fall drastically during the winter, right? That is a key assumption for an ice cream shop, right? You know that's going to happen, and you can tweak your numbers, tweak your projections based on that assumption. Other key assumptions can be, maybe there's been legislation that's removed certain restrictions or regulations on how businesses in that respective industry perform. Maybe that gives you opportunity to expand your revenue generating opportunities. So that is an assumption you can make based on these changes that are happening in the environment. Other key assumptions could be based on competition. Maybe there's been a surge of competitive businesses that have entered into the market, and they're going to be taking some of that market share from you. So maybe a key assumption is your pricing is going to have to go down a little bit to stay competitive, which might incrementally lower your revenues. That's an assumption that you can make, in which case you can pretty confidently tweak the numbers in your financial projections to just make sure it's going to be as accurate as possible.
Lots of different places that it sounds like you can pull from to get those really accurate financial projections. And I just want to mention again, a little bit of information about our Learn with AOF platform. I'm going to plug that one more time because I feel like when we start talking about, financial projections and we start getting into the nitty-gritty, this is when it could be so helpful to have that free and customized walkthrough support that's on your own time. You can save it and come back to it. So we're going to share that again. Takes 2 minutes to get started, but I just think it's a really valuable resource, especially when you're getting into the nitty-gritty of these financial docs. Okay, so my next question is, we talked a lot about what lenders, investors are going to be looking at. So what immediate actions can a business owner take to improve their business's financial standing so that we can increase that appeal to those funders?
Yeah, great question. Again, some differentiation between lenders and investors. The only thing I'll say about investors is, again, they're just looking at your revenues and your profits, and they want to just make sure that you're not overly leveraged with your debt. They want to make sure that if they're going to invest in your company, then they can realistically expect to make money on your company, right? So if you're not generating high enough revenues, or if you're not generating profits, or if you're over leveraged, that's going to be a bit of a red flag for them. With lending, it's a little bit more comprehensive. Again, remember, if you're taking out a business loan, there's a 99.9% guarantee that your personal credit, your personal financials will be part of the evaluation process for that loan application. So it's important that you are making sure that your business is performing financially well, but you also need to take steps to make sure personally you're in you're in an optimized financial position so that not only you're going to be able to get access to loans, but you're going to get access to good quality loans. None of those predatory loans that say no credit necessary or quick cash, immediate cash. Ignore all those. Those are predatory loans. So you want access to loans, but you want access to good quality loans that are going to build your business and not take away from your business, right? So what are lenders looking for? It can really be summed up in these five categories. We call this the five C's of capital. This is pretty much the common denominator of any loan application being evaluated. This is what every lender is looking at. So number one is character. This is going to measure, how reliable you are and how confident the lender is that you're going to be able to pay back that loan. So they're going to look at your credit score. They want to make sure that you have a high credit score because that tells them that you take your credit situation seriously, that you are, you've taken steps to proactively become a reliable borrower. They're going to look at your credit history. They're going to make sure that you are, you're not late with any payments from any of your other creditors. They want to make sure that you're on it, right? Then we have capacity. That's measuring your ability to pay back the loan. And this is going back to the debt service coverage ratio. This is going back to, are you generating, how much debt do you currently have? And if you take on more debt, are you going to be able to pay it back as things currently stand? So that's your capacity. Capital measures your commitment. So some lenders are going to ask you to put maybe, some of your own money down, right? 20% down payment. They just want to make sure that you have skin in the game. Some won't, some will, some won't. But like a mortgage, for instance, if any of you have a mortgage, you know that most likely you put in about 20% of a down payment. That's just to make sure that you are committed, that you're not just going to run away because you have nothing to lose, right? Collateral measures what you own. So lenders are going to see, look at your assets, your business assets, your personal assets, and they're going to say, well, in order to make sure that I'm not putting myself as the lender into a risky situation, I want a little bit of insurance. If I'm going to give you a loan, I want to make sure that, worst case scenario, let's say you default on your loan, you're not going to pay me back. I have something that I can take instead that has value that then I can liquidate and turn into cash and recoup some of those. So collateral would be things like a house or a car or equipment or maybe investment accounts, something that has value that they can take as an alternative if you decide not to pay back the loan. Okay. And then conditions. So this is kind of it's measuring two things. Number one, it's measuring your expertise, right? Are you qualified to be running your business? If you're running a restaurant, do you have restaurant experience? Do you have an advisory board filled with restaurateurs, restaurant managers, things like that? Are you giving enough confidence to the lender that you're going to be able to execute on the business in the best way possible? And the conditions is also measuring what's happening in the external environment, the things that you can't control. So, the state of the competitive nature of your industry. It's measuring risk in the industry. Construction. The construction industry comes with a lot more risk than, let's say, a smoothie shop, for instance. So they're looking at the industry. They're looking at government factors that might be changing how that industry performs. So they're kind of looking at what's happening around and looking to make sure it's not a risky type of business, right? So those are really the five, and we can go into this for hours, which we're not going to. But this is essentially what lenders are looking at as they're evaluating your application. So if you can optimize all five of these categories, conditions being the anomaly here because there's only so much you can do about that. But if you can focus and create a strategy for making sure that you're fulfilling, you're putting yourself in a strong position with all five of these categories, you're in a good, strong position to take out a good quality loan with low interest rates, with flexible terms, with reputable lenders that are going to help you grow your business and are actually going to help you use debt as a tool for wealth building.
Yeah, I really love that. And I like how it's kind of a guidepost to the quality of loan. So if you know that folks are looking for these things, that those are probably more, like you said, those trustworthy, really good quality loans for your business. Um, Okay, so when an investor is looking at my finances or my cash flow, what are they looking for?
Investors specifically?
Investors and yes, when investors.
Yeah. So like I said, investors are looking at your revenue generation.
Mhm,
They're looking at your profits.
mhm.
They're looking at your current debt obligations to make sure that they're not going to invest into a business that's just going to use that money to pay off its debts, because that's not doing anything for the investor. They want to make money on their money. Um, and the biggest thing that I think, if I were to put my investor cap on, which is an imaginary cap because I'm not an investor, but if I were to do that, um, I would specifically be looking at the what the business owner is proactively and strategically doing to capture market share in their industry, right? What are you doing as a business owner to differentiate yourself from your competition, and what are you doing to become the leader of this type of business? Meaning, how are you going to beat out your competition? Now, saying that you don't have competition doesn't work for me, and it's not going to work for investors. Number one, just economics 101. If your business is successful and you don't have competitors, they will come. I assure you with 110% guarantee that if you are making money on your business and you're the only one doing it, they will come, and they will come with a vengeance. I can speak to my own experience here. I ran my own business. We were the only national provider doing what we were doing. And we had a couple of our own employees decide, you know what? I think I've learned enough from these guys. I think I can do my own thing now. And they essentially became competitors. Wasn't super cool, but hey, free enterprise, right? It's their right to do it. So if you're successful and you are the only one doing what you're doing, know that the competition will 100% come, and you need to have a plan for that. You need to have a way to stay differentiated, and making sure that you are updating your value propositions so that you're staying ahead of your competition. That's what I would be looking at as an investor, because I want to make sure that maybe you're doing really well right now, but this is a long-term investment. And I want to make sure that you're not going to, lose speed as other, folks are kind of bringing their businesses to the market. So I want to see that you're doing something to capture market share.
Yeah. Oh, that's so helpful. And thinking about like, if you don't have competition now, it's coming. Okay, so what steps can I follow if, I'm a business owner to ensure that my financial records are accurate and up to date before I start seeking funding?
Yeah, it's a good question, and this is the part of the webinar that I'm going to say, make sure you do this, and that is, be have organized bookkeeping, have an organized accounting system. It's obviously you don't want to have everything on an Excel spreadsheet or on a piece of paper. You want to be able to track something in real time. So QuickBooks. Obviously, everybody knows QuickBooks. They have multiple different packages. I think their most their cheapest package is like $7 a month or something like that. But whether it's QuickBooks or Xero or Wave or any other simple accounting software, get something, and not only have it, but use it to its full efficiency. Don't just have QuickBooks and then just have a bunch of uncategorized transactions on it. Don't have QuickBooks. If essentially, I'll put it this way: if you if you have QuickBooks and you pulled a profit and loss report for last month for September 2024, and you pull that report and you don't think that those numbers are accurate, you have some work to do, right? You as the business owner, you need to be able to pull or a report, whether it's yearly financials, monthly financials, quarterly financials at any given moment, and know that those numbers are accurate and start making some strategic decisions based on those numbers. If you're not in a place right now where you can do that, you don't have that a certain degree of confidence in those numbers, then I highly, highly recommend you carve out some time on the weekend, or maybe during a time that you're not super busy. Spend some time getting your accounting system up to date, making sure your chart of accounts are correct, and making sure that you're positioning your accounting system in such a way that you can easily pull a report and say, okay, here's what's happening with my cash flow. here's what's happening with my P&L, and here's some changes that I want to make based on that information.
Yeah. So not only, having the right software, but then using it and taking the time to use it, which I know we all want more time, but it sounds like really imperative when you're trying to get funding. So, okay, what are some effective strategies small business owners can use to consistently monitor their financial performance?
That's a really good question. Good segue. You know, I can speak to my own experience. I started my business in my mid 20s, and I had some financial education from college, but I never really put it into practice when I was running the business because we just went from 0 to 100 in very short amount of time, and it was just playing catch up. For a year, for 2 years, we were just playing catch up. And our financials were a mess. It was a disaster. We could not do anything. We could not figure out what to do or how to grow or how to expand because everything was all out of whack. What I wish I did and what I would be doing now is getting really organized with your time. Okay. You're all business owners. You're very busy. Your time is very, very expensive. Okay. You need to look at your time from a monetary aspect, and you need to be saying, if my time is worth $150 an hour, let's say, and I've wasted an hour, looking into something for my business that just, didn't matter. It's not giving me anything of value. You lost $150 in that hour. You have to start looking at it that way. So my big kind of suggestion here is take some time to organize your time. Okay. Look at your weekly, monthly calendars, start putting in blocks of time for things that you know you need to do. And that should include breaks, that should include fun. You should include blocks of time on your calendar where you just step away for a second and go just scroll Instagram for 30 minutes if that's what you need to do, whatever. You just need to organize your time strategically so that you are addressing all the things that you need to address for your business, even the things that aren't super fun, or even the things that don't seem super critical. And getting your financials organized is one of those things. Block some time out once a week, 1 hours, 2 hours, once a week. It's not asking that much to get your financials organized and know what you're looking at and knowing how to monitor the health of your business. So I would say commit that time. Don't get distracted. If you're monitoring it at least bare minimum once a week, I would be doing it every day, but I'm a financial guy and I live on spreadsheets and QuickBooks. At least once a week. That will put you in a much better place where you're a little bit more organized. You know what's going on. You know what you need to adjust. And you can essentially put yourself in a position where you can start making high level strategic business decisions based on your financials.
Oh, so cool. And I love the concept of tying money to your time because that is just such like it just makes me feel like, okay, let me efficiently use the time I'm about to use. So cool. Okay. So how do I or do business owners, how can they gain confidence in their financial plan and all these numbers we're talking about?
Yeah, very similar to kind of what I said before about putting projections together is, stay up to date with what's happening around your business, the market, the industry. How is it changing? What new technologies are coming in that's going to make things more efficient? What are the barriers to entry? Is it easy for people to come and compete with you? Is it hard? Are there, what's going on? You can't build a house without knowing the state of the dirt underneath, right? You need to know what's going on around you to be able to position your business in the best way possible and start making strategic business decisions. So do the research, understand your market, understand your industry, understand how it's changing. I would definitely take a look at, just based on where you are, you may have localized resources through your local chambers of commerce, through your local economic development centers. They might have a lot of free or low cost information for you that you can build insights on. One thing I would recommend is looking at your local public library system. Okay. I don't know about most states, but I'm familiar with Washington, California, and Colorado, all of which have a very, very awesome public library system that has access for small to information for small businesses, market research data, competitive data, census data. Well, census data is federal, but you can still find it through your local library system. This is all valuable, very relevant information for your business. So check your local library system, check county by county, and get in touch with somebody on the phone and say, hey, I'm a small business. I'm trying to find market research data. Can you point me in the right direction? What do you guys got for me? I'm pretty confident that you'll be able to find something. But again, it just depends on where you're located and what county you're
Mm. A great starting point, though, to like go to those local resources and have them point you in the right direction. Okay, so we've talked about so much today, but if you could offer just one piece of advice or one main takeaway for our audience about preparing for that funding and being prepared for it, what would you say?
in. Yeah, there's a lot. But if I were to drill it down to one thing and one thing only, at the very, very minimum, get organized. Get organized with your credit, get organized with your business financials, get organized with your personal financials. Know where you stand financially, because ultimately, whether it's an investor or a lender, they're going to be looking at the same things. So it's good for you to be aware of where you're at. So clean up your accounting, be able to pull profit and loss and cash flow reports, be able to know what you're looking at. If you've had issues with your credit in the past, maybe you've had some collections or charge-offs, or maybe you've had a bankruptcy back in the day, whatever the case may be, look at your current credit report. You get a free one every year for all three bureaus, Equifax, Experian, and TransUnion. Understand where are the kind of what negative issues you might see. Maybe you forgot that you took out that Sears credit card 10 years ago, and you've been owing money on it, but you haven't known about it, and you have a charge off on it. And looking at your credit report will allow you to figure that out. So you need to understand, assess your financial situation, and get organized and fix whatever you got to fix. So you're putting yourself in a strong financial position, whether you're approaching a lender or an investor.
Love that. So just like getting organized, making sure you know what's going on with your own stuff. And then I know I mentioned that was going to be the last question, but I actually remember, Oren, we were talking about a really great example of how to structure your asks when you are talking to lenders. So I want to share my screen, and I just wondered if you could kind of take us through like what is the best way to make the ask for money?
Yes, no, this is crucial, and thank you for remembering this. I work with a lot of businesses. When I'm talking to them about accessing capital, they want to talk to a lender, and they're just trying to figure out, trying to talk to me to figure out the best way to do it. A lot of them say, I need $20,000 for marketing. Okay, like that's it. Have you thought more about that? How exactly are you going to make a return on that? Have you thought that through? So I always say, if you're looking for capital, you need to have a strategic financial plan, right? You have to know exactly how much you need, and that shouldn't be an arbitrary number. That should be a number based on you actually having done the work of assessing, okay, I need to spend money on this, I need to spend money on this, and I need to spend money on this, and this is going to result in this return. So instead of saying, I need $20,000 for marketing, I would expand that a little bit. And here's kind of my example. So my goal is to access $20,000 in capital to fund several marketing campaigns in 2025 that will increase traffic on my website, leading to increased sales. This will include comprehensive marketing services, including social media activations, primarily through Twitter, Facebook, and Instagram, paid advertising, including Facebook and Google, as well as revamping my website with search engine optimization or SEO, and ongoing marketing support like website maintenance and things like that. I project an annual revenue increase of $50,000 per year as a result of this marketing investment, which will allow me to pay back the loan and increase my profit. I will invest $5,000 of my own money, bringing the total cash injection to $25,000. So with the $25,000 investment, you're generating $50,000 in additional revenue. At least that's the projected amount with a certain degree of confidence. So you've made a two times the return on your investment there.
Love that. That is so like clear, and it kind of, I love that it has the extra, I will invest 5,000 of my own dollars. It reminds me of that 3 C's or 5 C's, sorry, that we talked about
Yeah,
earlier and putting a little skin in the game. Okay.
exactly.
Thank you for answering all of those questions, but you're not off the hook just yet. I have a bunch more questions for you. The chat has been popping off, and so I feel like a lot of folks are really, resonating with this information. And so I want to just remind folks that everything we talked about today is going to be in the follow-up email. So if you need to revisit something, definitely check that out. We'll have all of those resources there for you. And especially if you are trying to, wrap your mind around all of these different things or plan your financial path, please check out that Learn with AOF platform, because I promise you there is something in there for you as you continue to grow your business. So one of the questions we got, Oren, is what % is a healthy amount of extra cash to have as a business owner?
Hmm. Yeah, it's a good question. There's no uniform amount, I would say. It really just depends on where your business is at in its life cycle. So, if you're post startup, you're just starting out, maybe you got a startup loan or some sort of seed funding, the amount of cash in your bank, a healthy amount of cash in the bank might be a little different from, let's say, a more matured business that's operating at higher revenues, that has large inventory, large costs when it comes to generating inventory. So the amount of cash for a more mature business in the bank might be significantly higher. So there's not really one, I guess, uniform percentage of how much you should have. It really just depends on the circumstances, and should be determined based on what your financial goals are. Yeah, I mean that's really all I can say. I can say about that, just because it's so subjective, unfortunately. But it should be determined based on how much do you need for worst case scenario. Worst case scenario being you have all these unexpected expenses coming through, you're not generating enough revenues to cover all those expenses, and you're going to need to rely on some of your cash reserves to cover those losses for a while. The amount of cash in your bank should be determined based on what that scenario might be, how much cash you might need to kind of cover those losses until you can generate more revenue and still have some cash in the bank to keep operating the business.
Okay, that's a great like framework to start figuring out what that percentage should be. Um, is there a benefit for applying for low or lines of credit versus loans?
Yes. So unfortunately, we can't get into this in too much detail. Comparing different financing products based on, what your, the necessities of your business. But it depends on what you need and depends on your preference. So, like a term loan, for instance, you're looking at, let's say you took out $100,000 in a standardized term loan, right? What's going to happen is they're going to dump $100,000 into your bank account and they're going to start charging you interest on that $100,000, right? Whereas if you have $100,000 line of credit, you just have this bucket of money that the bank is holding with $100,000 in it, and you just pull what you need out of it, kind of like an ATM machine, and then you just get charged interest on what you're actually using. You're not getting charged on the full $100,000. So lines of credits are very appealing in that sense because you have the money there ready to go, but maybe you don't necessarily need all of it at once. So why pay interest on all of it at once if you're not spending all of it in one go? So that's what's nice about a line of credit. But a term loan, on the other hand, maybe you know exactly where that $100,000 is going. You want to deploy every dollar as soon as possible because you've got big plans for your business and you just need that 100,000, and maybe you have a better interest rate with a term loan as opposed to a line of credit. So maybe the term loan makes more sense. But it just depends on the circumstances of your business, what your financial goals are, and what kind of terms you're looking for.
Got it. Okay, but we have a couple of questions about where to find that benchmark data. So I think we covered this, but maybe just if we could reiterate, where can we look for that benchmark data if we're trying to do those projections?
Yeah, they're kind of all over the place. There's, the free research, and then there's the paid for research. Obviously, if you go for the paid research, you're going to get a lot more valuable information. If you have a budget for that, I would definitely check out IBIS World, IBIS World. If maybe Emma, you want to throw that link in there. I'm a huge proponent of IBIS World. Anyone on my team will know I'm like a broken record. I always talk about IBIS World reports. That's the Cadillac of market research, market data, and industry data. Um, there's others out there as well, but as far as free, again, I would check your local library, public library system. It's all funded through tax dollars, so they're already getting paid for it. You can access it for free, and look at your local chambers of commerce. For those, I think I saw some folks based in Atlanta. I can tell you, Atlanta is awesome. They're amazing when it comes to business development, small business resources, economic development. There is so much. Atlanta is awesome. You just talk with an agent from the Chamber of Commerce, and they're going to throw so much at you, you won't even know what to do with it all. So it just depends on where you are. But definitely check with your local counties, your local municipalities. Go on their websites, search for small business resources, or even just go to Google small business resources Atlanta, Georgia, and it should be able to pop. Most the government websites should pop up first. Try to avoid like the sponsored results, but it's out there. You just have to start local and kind of work your way out.
Love that. Okay, so if we're not getting anywhere where we're at, we gotta hop on a plane to Atlanta because it sounds like they're the gold standard, or we need to get on IBIS World. So I know we've had other questions that we weren't able to get to because we're at the top of the hour, we're even just a scotch over, but that's because this content is just so robust, but we're not leaving you without resources. So keep your eye out tomorrow so you can get all the links that we talked about today. You can get an article, Oren's recording if you need to revisit something or even see the slides again. And also all of the articles and resources we've shared, like that Learn with AOF platform, if you want to dive a little deeper. So we appreciate y'all taking an hour out of your day. As we even heard in today's conversation, your time is incredibly valuable. So we appreciate it. All right. Thank you, everyone. Thank you, Oren, for taking us through this today. And we will see you in the next one.